Guys, I just came upstairs, I just gave blood and a urine sample, and I thought this would be a fantastic video that most people are not gonna be watching, but I promise you this is one of the most important videos I can possibly make. And if you are a parent, you should be glued to the freaking seat and ask yourself if you're doing the 3 things that I'm talking about today. You see, downstairs I was taking blood work and a physical for more life insurance. As a parent, I believe that you should do 3 things because unfortunately, when you pass, if your children are not of age, then your responsibilities to be a man or a woman of the house do not end with your death. Unfortunately, it does not work like that. And if you want to be remembered in this life, the best way to do that is to give life and nurture the life that you gave. There are 2 types of life insurances. Before I go any further, by the way, I'm gonna cover 3 things, so stick around. There's 2 types of life insurances. There's a term life and there is a whole life. A term life is the really cheap version of an insurance policy where you pay a monthly fee for a certain amount of time, and if you, God forbid, pass away within that certain amount of time, your beneficiary will get your funds. For example, you have a 20-year term life. You pay $100 a month. You're gonna get a $1 million policy. If you pass within 20 years, $1 million goes to your beneficiary. You can do a 20-year, 30-year, 40-year. I don't think I've ever seen more than a 40-year. Now, there's something called a whole life. A whole life, besides for an insurance policy, is also a great investment vehicle. A whole life is for your entire lifespan. You invest a lot more money than you do with a term life. And it's literally an investment vehicle that you can borrow against. For example, let's just say you have a $500,000 policy. You say that you want to do an investment vehicle over the next 15 years. And this investment vehicle is you want to put in $10,000 every single year for the next 15 years. So you accumulate a certain amount of money, let's say $150,000. If anything shall happen to you, period, that $500,000 is safe. But you're accumulating interest on your investment. So if, as you're gonna get $150,000 in there, you can borrow against the $150,000 in equity and pull it out to a certain percentage. Let's say you have $150,000 in your whole life insurance. You want to borrow $100,000. Your life insurance policy is $500,000. They will deduct $100,000 off of the $500,000. If something shall happen to you, your beneficiary will get $400,000 instead of $500,000. Now I'm oversimplifying the entire procedure, but you get the gist of it, and this should definitely open up your mind. There are very cheap insurance policies that you can get, which cost you literally $50 a month, $20 a month, smaller policies, 100,000K, 50,000K. It's not much, but it'll cover some expenses if you pass, because it's not just nurturing your children, nurturing your family, it's also taking care of your bills, right? Funeral costs are super expensive. Burial, casket, cremation, priest, rabbi, imam, whoever's speaking, this all costs a lot of money. The best thing about life insurance, whether it's term or whole, it is non-taxable, which means if you have a $1 million policy, that $1 million is non-taxable. It's clean and free. The only thing that you need to take into account is inflation. So if you think that you're going to be doing a life insurance policy that's $1 million, $1 million is worth a lot less in 10, 20, 30 years than it is right now. So you might want to get a larger insurance policy. Just keep that in mind. So now we spoke about insurance policies. The question is, hey, Adam, what's the second thing that I need to do as a parent? As a parent, you need to open up something called a custodial account. This is just an account that you, as the guardian, runs for your child. I have a custodial account for my son. If you want to open up a custodial account, one of the easiest ways to do it is something called M1 Finance. I'm not shilling it, but I do have a link down below to M1 Finance if you want that. The reason why I like M1 Finance is because you add the stocks that you want to do in a pie and it automatically buys for you. The reason why you want a custodial account is The next time your parents, the next time your aunts, the next time your siblings, the next time your friends give you a present of cash for your child, literally put that cash into their bank account that, again, you're running for them, and deposit that money into the custodial account and invest for them. Now, when you're investing for them, you invest whatever you feel is right. But keep in mind, your child is very, very young. So this investment account is going to be for the next 18, 21 years, usually. So invest knowing, and whatever this means to you is what it means to you. Will mean different something to me, right? And everybody has a different opinion of what this means. When you invest in a custodial account for your child, invest knowing that this is a 20-year horizon, right? So this is a very long-term play. Usually in a custodial account, you don't want to trade the stocks because a custodial account is taxable. However, it's not as taxable like you guys think. It's not like 100% taxes. I'm going to break it down very simple for you. There is something called a kiddie tax. Now, the kiddie tax gets stepped up every single year, so these numbers are going to change. To make it very, very simple, the first $1,150 that you make for the year is non-taxable. It is completely written off. You don't have to pay taxes on it. This is very important if you want to have a dividend stock portfolio for your child. For example, if you have a $100 investment and you have Walmart, which pays like a 3% dividend, let's just say, that's $3 that you're making every single year. So that $3 now is not taxable. Again, 20-year time horizon, 21 years, 18 years, whatever. And I'm just giving you a basic example. So you might want to be like, hey, if I'm making a certain amount of dividends and my investment is not like huge, right? And think about it. Even if somebody has a $10,000 portfolio and it's dividend and it's paying 3%, it's still going to be a non-taxable event. Then you might want to invest in these type of safer type of plays. Now, for me, I like to do aggressive plays because I think for the next 20 years, tech sector is going to grow, innovation is going to grow. But again, that's not for me to decide what you do with your kid's money. After the $1,150, the kid gets taxed on the lowest tax bracket, which is his own or her own personal tax bracket. But after $2,300, you get taxed. So your children will pay taxes your income. So whatever your tax bracket is, that's the taxes that are going to be paid. Why? A lot of people try to get away with not paying taxes to go through a custodial account for their kids and try to circumvent paying taxes. So the government figured this out and they said, hey, up to $2,300. After that, you guys have to pay your own personal tax bracket. Now, the kiddie tax is good until 18 years old. And if I'm not mistaken, you get an extension until 24 if the child is actually going to school. Don't quote me on that, and definitely do your own research with everything that I'm telling you. Everything should be used as a guide and not 100% facts. At the end of the day, I'm just an entertainer and educator at best. I'm not a financial advisor of any kind. And while you're here, if you're getting anything out of this video, please do me a favor, click the like, share, and subscribe down below. I have a feeling this is going to be one of those most important videos ever that nobody's actually going to watch. So now we covered life insurance, both term and whole. Now we covered custodial accounts, how to open the custodial accounts, and the basic taxes on custodial accounts. Now I want to talk to you about your will. This is the third thing that everybody should have. And in your will, I would also talk about something called a trust. A will is just a last will and testament where you write everything down and say, hey, this is what I want to happen when I pass away. This can include anything that has to do with your child and anything that has to do with your funds. For example, if you have a piece of real estate and you pass away, and let's say you're a partner, you can say, hey, I want to sell my shares in the open market. I want to sell my shares of this property to my partners. I want to gift my shares to my child, to my wife, whatever. So that's a last will and testament. When you have a will, you should also have a trust, especially if you have a lot of money. What happens is if you have property and assets and the life insurance, you can put it in a will and say, hey, this is going to go to my child. But if you say that it's going to a trust for your child, there's a lot better ways to spend that money, and it's a lot safer. The owner of the trust should be somebody that you absolutely trust. I'm gonna give you a quick example. Let's say you pass away, that's $1 million life insurance. Let's say you also have real estate and you don't wanna sell your real estate, you wanna gift your shares of the real estate, but you wanna collect the rental income. Let's say the rental income is another $100,000 a year, whatever. So now the trust is gonna have $1 million in it plus $100,000 of residual income. You can then, through the trust, say, hey, my son, if he's 10 years old, I know that he needs to go to school for the next 11 years until he's 21 or 25 or 30. It doesn't matter. For the next 10 years or 11 years, I want to allocate $100,000 a year for my son, for my daughter, for my wife, for whoever's taking care of my family when I'm not here. The trust will then allocate the funds as you wish. Having a trust is a lot more secure. Having a trust is a lot stronger when it comes to law. And having a trust is gonna give you an extra level of protection for when people come after your assets when you pass away. Because unfortunately, when you pass away and there's no will, there's no trust, people come after your assets. You're gonna be so surprised of if you're successful, all of a sudden, everybody and their mother is somehow related to you in some way, shape, and form, trying to get a claim to your hard-earned money. So just to recap, and if you don't do this, I want you to really look at yourself in the mirror and ask yourself, as a parent, do you do this? Do you have a life insurance policy for your child? If not, get the F up and go get one. Do you have a custodial account for your child? If not, get the F up and get one. Do you have a last will and testament or trust for your child? If not, get the F up and go write a will on a piece of paper. The trust is gonna cost you money to set up. However, a will is binding on any piece of paper. When you do a will, probably keep one in a safe place and then put another will into a piece of mail and send it to you certified. So that in that piece of paper, you're gonna say, hey, this is to certify this is actually my official will, and it's gonna be locked so that when it's read by the attorney, this proves that it's actually your will. Because some people do forgeries. Now, this is some high-level bullshit, right? But it can happen. Guys, I hope you liked this video. I hope you got something out of this video. And if you do want to open up a custodial account, I do have a link down below to M1. You're gonna help out the channel. And you're actually gonna get something free as well when you set up the account for your children. Guys, thank you so much. Have a great day. Live a long, prosperous, healthy life for you and your family. But the things that we never want to talk about are sometimes the most important things in life and afterlife. The Berg is out.